Just us.
Good afternoon, everybody. I'm Geoff Garrett, Dean of the Wharton School. By the way, we can't see any of you. I can hear some applause out in the audience, so thanks so much for being here this afternoon. This is part of a really important lecture series at the Wharton School in honor of Mickey Tarnopol, who was Vice Chair of Bear Stearns, among other things, an important pair of words for 2008. Also, a long-time overseer of the Wharton School and Vice Chair of the Penn Board of Trustees. He was also a recipient of the highest honor we've got at the Wharton School, the Dean's Medal, and he founded the Penn Club of New York in Midtown, for those of you who haven't been there. What are we talking about today? This is an incredible week, I think, in the United States and for the whole world, because if I look back on the first 18 years of this new millennium, the two most important dates are 9/11 and 9/15. 9/11, 2001, obviously the tragic events at the trade towers in New York. 9/15, 2008, the fall of Lehman Brothers and the beginning of what's been known as the global financial crisis. So today we're looking back and looking forward on the 10th anniversary of the financial crisis, which I guess that Monday will be this Saturday, 9/15, and that means that we're on Saturday morning in New York on the weekend before Lehman Brothers was not bailed out and went bankrupt. What happened back then? The fall of Lehman Brothers, that's 9/15. Then we had an expression that went global almost overnight, global financial crisis, followed by another important expression, Great Recession. And amidst all of that, we had, I think, literally unprecedented, coordinated global economic policy action. And that all happened within about 6 months. I think the last event in that sequence was a G20 meeting in London in maybe April 2009. For those of you in the audience, many of you are pretty young, and 2008 seems a long way ago. I'm not so young, so 2008 doesn't seem so long ago. 10 years ago, I was in Australia. And Australia is not only on the other side of the world, it's a country that has a pretty insulated, protected, and highly regulated financial system. Unlike, for example, European banks, the Australian banks weren't very heavily invested in Wall Street. Why does that matter? Because with the fall of Lehman Brothers, there was a near instantaneous freezing of credit markets in Australia. So much so that the kind of crisis meetings that were happening in Washington, New York, and London were also happening in Australia, literally at the same time in real time. That showed me that this was truly a global crisis, and it was moving at warp speed. So let's do a quick before and after. I get to be in New York tomorrow morning. Robert Shiller, Yale economist who subsequently won the Nobel Prize, dubbed the first half of the 2000s, of the first decade, the decade of irrational exuberance. What did that mean? One thing it meant was incredible financial innovation, which really began in the Clinton administration, I think, when Larry Summers, as Treasury Secretary, bailed out long-term capital management and said a reason to do that was we wanted more financial innovation. And then lots of abbreviations became the tools of the trade: MBS, CDO, CDS, SIV. These became really important terms in financial innovation. I think it's also important to remember that the pre-2008 period was one of incredibly low interest rates already. Why? Partly because it was post-9/11, and Alan Greenspan, who was heading the Fed at the time, thought that low interest rates were an important domestic response to the war on terrorism as it came to be known. But Ben Bernanke, subsequently head of the Fed, also dubbed this term global savings glut, which was probably mostly about the flood of Asian money into the United States, above all from China, the newly empowered China. And then, of course, the last thing that was going on back then was unprecedented increases in home ownership in the name of access. And of course what that meant was access meant making home ownership available to people who otherwise wouldn't qualify for mortgages, among other things. And what we now know is that mortgage companies took advantage of that by flipping houses and flipping mortgages. Those were really terms that were used a lot then. Okay, so that's pre-crisis. What about post-crisis? Well, I think we've just got to remember how deep the recession was, right? So 2009 was a year in which world trade declined by 30% in 1 year after year-on-year increases for the 30 years before that. Deepest recession since the 1930s. Then we had, I think it was in the first week after the crisis, there was something called TARP. Can't remember what TARP stands for, but I remember the dollars associated with it. It was a $700 billion stimulus that I think Hank Paulson, the Secretary of Treasury at the time, wrote in a one-page bill to Congress, its first version. Then we had another new acronym that came into play, QE, Quantitative Easing by the Federal Reserve. Once interest rates went to zero, that wasn't enough. We had to do more. What did the Fed do? It bought debt. The Fed's balance sheet increased from under $1 trillion to $4.5 trillion during the crisis and the recovery from the crisis. We also had big change in regulation of the financial sector through something called Dodd-Frank, which imposed greater liquidity requirements, capital asset ratios on banks, less leverage for banks, more regulation on what banks did. Then what's happened since? Well, we know we've had a recovery. It's now a very long recovery, but most people think it's been a much shallower recovery than others in American history. And we've continued to have lots of financial innovation. It just looks different from the period before. All right, what should we make of all that? There are lots of big picture kind of retrospectives on the financial crisis that you can read in every journalistic outlet right now. One of the ones that's out there says the financial crisis laid the seeds for the Trump administration. Why? Because the recession was deep, long-lasting, and adversely affected a lot of people and made quote-unquote average citizens angry. Interesting question. Second, globalization. Back then, I think one of the remarkable things about 2009 was coordinated global action. Whereas today, we have less or maybe anti-coordinated global action. Interesting dichotomy. Financial system. The banking system is clearly much more regulated than it was before, but there's a lot of stuff outside formal banking regulation rules, and some of our panelists represent real success stories in that area. Is the financial system safer? Maybe one of the retorts to that is it depends how you describe the financial system. What does the financial world look like? And then, last one that I think is very important is this question about economic policy. Are we ready for the next crisis? One of the reasons we might not be ready for the next crisis is all the policy bullets that were fired during the crisis. So we ran up public debt, we pushed interest rates down, we had QE. Are we ready for the next crisis? All big questions. And maybe some of our panelists will want to opine on them. But I think, the primary focus for us, a comparative advantage, is really to focus on the world of finance, the future of finance. Focus on opportunities, not just on challenges. And I'm so pleased to have an incredible panel of Wharton alums, real friends of the school, joining me and us in this conversation today. I'm going to go through them in alphabetical order by last name. There are many ways to introduce panelists, and that means Jamie Dinan is first. Jamie is the founder and CEO of Your Capital, one of the most successful hedge funds in the United States. He's also a Penn trustee. He's the co-chair of our current Wharton fundraising campaign, and he has an impish sense of humor. Jamie, thanks for being here today. Ruth Porat, I don't know whether Ruth is here. Hi, Ruth.
Hi, Ruth.
Ruth has a kind of big day job, which is on the other side of the country. She's the CFO of the parent company of Google, Alphabet, and also the CFO of Google. But during and after the crisis, She uniquely straddles both coasts because she was CFO of Morgan Stanley and was asked to play important roles in responding to the crisis in that role. And Ruth graciously agreed to be our inspiring MBA speaker a couple of years ago. So Ruth, welcome to you. Third, Marc Rowan is to my immediate left. Marc is a co-founder and senior managing director of Apollo Global Management. I think now, in terms of assets under management, the second largest private equity firm in the world after Blackstone. I don't know if we all count those things the same. And I don't know why that was humorous, but I think that it is generally believed that Apollo is the second largest PE firm in the world. Marc's also, like Jamie, a Penn trustee, and he's the chair of the Wharton Board of Overseers. So in important respects, he's my boss. I will try to be appropriately, I will try to act appropriately, Marc, in your presence. Last but not least to my right, Robert Wolfe is the founder and CEO of 32 Advisors. We were just talking about this. 32 is a famous number for people who follow American football. The star running back tends to have the number 32.
Yeah, that wasn't me.
But Robert was running back in 2 years in a row when Penn won the Ivy League football championship. He also is into drone services these days through a venture called Measure. But back in the crisis, he was the CEO of UBS Americas and really in the vortex. And some of your personal experiences, I think, are going to be wonderful to share with us all today. And Robert's also a member of the Wharton Graduate Executive Board. So enough from me. Ruth Porat is politely on her screen ready to go. What we asked Ruth to do, because her time is incredibly short, is to make some opening observations for a few minutes. Then I'll ask her a few questions, and unfortunately we're going to have to let her go back to her day job. But Ruth, it's great to have you here. Could everyone join me in welcoming Ruth and everybody else? The stage is yours.
Well, thank you for having me, and I do apologize again for not being there in person. So when Dean Garrett asked me to kick off with some of the recollections about lessons from the financial crisis, it really took me back to those days 10 years ago. I'm sure you've all been reading and seeing the recollections of the recession. I was actually in Washington, D.C. earlier this week at an event hosted by Secretary Paulson. I'd had the opportunity during the crisis, when he was secretary, called and asked if I would help lead a team to analyze and take them through what to do with Fannie Mae and Freddie Mac, as well as then working with AIG. And so Secretary Paulson, along with Ben Bernanke and Tim Geithner, brought the whole group of us together who had been working on this. It was literally getting the band back together to reminisce about those days and the lessons that were learned. And what really hit me, and you said it a lot in your opening comment, was how fortunate we were to have had Secretary Paulson in that seat at that time, playing the leadership role, and to have had President Bush have the judgment to really defer to the team that was assembled there, because in my view, the country really benefited from that type of leadership, and we would have been dramatically worse off if we didn't have a team that moved with that speed, deliberateness, and really helped guide through what was a very tricky situation. And what really also strikes me about the lessons from the crisis, and I'll dive right into them, is how relevant they are today for all industries. It's not just that it was a moment in time and we've moved on, but I view them as relevant today, and they're very much a part of how I think about the way we run our business. And I've distilled the lessons really into 4 of them. The first and most important is that every company, every industry needs to identify its source of vulnerability and protect against it in the good days. So during the crisis, the biggest issue for all of us was liquidity. Without liquidity, you choked. And that's literally what happened to banks and to the financial system. And in the heart of the crisis, you can't find liquidity. You can build it early, but at that moment, you choke. That's lesson number 1. The second very important one is the imperative to build data, analytics, risk measures, transparency. Again, you need to do that well ahead of when you need it. And the metaphor I think of is you would not drive a car with mud on the windshield. You similarly should not run a business with mud on the windshield. You need to have visibility and transparency. And to me, the most frightening moment in the financial crisis was actually AIG. So if I go back to those days, I was down at the New York Fed during the Lehman, what's now called Lehman weekend, went home on that Sunday and literally got a call from the Treasury saying, we worked on the wrong thing, can you come back down? And it didn't seem real at the time, but their comment was, it's AIG. AIG will be out of money by Wednesday. This was late on Sunday night. And so we went back down to the Fed and did work on AIG. And as many of you have probably read by now, the issue with AIG was their derivatives sub in the UK. And there was not nearly the level of awareness about the risk and the exposure that was going on in this other part of AIG's world. So without the systems and controls, risk analytics and tools, you are like driving a car with mud on the windshield. You need to invest in that early. The third really important message is actually something that Hank said to me in those dark days, kind of around the time he was drafting that memo, trying to get Congress to support one of the moves. He said, you have to have the will and the means. And too often by the time you have the will, you no longer have the means. And I thought of that again during the crisis in Greece, where if people had intervened early, we may have prevented much of the spread to the periphery. The problem is, by the time you get the political will, you may not have the financial capacity to address it. And I think, again, that's true for each of us who runs businesses. It's easy to be sort of lax in the way you use resources in good markets, and then you regret that later when you could have actually focused them to build a stronger position. And I think the fourth and really important message is, and we learned it over and over again, you're only as strong as your team. And what was, really extraordinary in those days is we had to move really quickly. The phrase back then was you were picking between least worst options. There were no good options. You really had to have instinct based on experience. And what Hank did is really bring together a team that was able to have that instinct based on experience. And that's guided me as I think about how to build my team. I want people who have what I call battle scars. It's my first interview question. I want people who have pattern recognition because they've been through these types of good days and bad days before, so that they're thinking 3, 4, 5 kind of plays down the field, to continue with your football metaphor. And that to me was one of the most important elements of what we do. And so as I think about the students who are there, to me, your first role coming out of Wharton, this is a paid postgraduate education. And get yourself in a place where you can develop the best skills and training so that you do have that pattern recognition. When Secretary Paulson asked if I would help work on the housing situation, I would say that I feel that this was one of the most important opportunities that I've ever had. The ability to use skills developed over a career in banking to something that was so important to the country at the right time. And so I encourage you to put yourself in a position where you're learning those skills, where you have those opportunities, and never stop learning. Those would be my main lessons from the crisis.
Thank you very much. Lots for us to chew on there. Let me see if I can pick a few things that stand out. You just talked pattern recognition. Of course, we've got all these sexy terms now: machine learning, natural language processing, AI, etc. Google's pushing the envelope on all of that stuff. There's incredible interest, as you and I have discussed, in fintech. Google's not in the fintech business. When you think about the business implications, the financial implications of AI, etc., what are you thinking about beyond the world of Google? I mean, Google's a very big world, but beyond that, how do you think about it?
I think machine learning, AI, is one of the most exciting and transformational opportunities that all industries have. I'm very much of the view that every industry can be defined by those who embrace and don't embrace ML, because it creates new revenue opportunities and new opportunities for efficiency. And so it's going to be a core part of every business that each of us is in. It's also easy not to appreciate how much we're already benefiting from machine learning in products and services. So just quickly running through them to give you a sense of the breadth of applications. Today, when you do voice search or image search, when you go on photos and search by family member or a place you've been, that's all benefiting from machine learning. We're using it in advertising. It helps advertisers with better placement and measuring ROI on their spend. It's a valuable part of the offering when we talk to our enterprise customers. How do we work with them, not just to address their storage and data analytics requirements, but to apply machine learning to their businesses? It's core to what we're doing in health and life sciences across Alphabet. We have a couple of life sciences businesses, and I think this is probably one of the most exciting applications for machine learning. It can help with disease management. You know, if you think about it, we can monitor what's going on in your body on a continuous basis, and the ability to process that data and then know when to intervene so you're taking medicine from being reactive to proactive. It can help with diagnosis. It can help with managing care in hospitals. Today, even today in the US, the third highest cause of death is error in the hospital. And that, in part, if you think about it, diseases don't follow a linear path. So as your body's going in a lot of different directions, the ability to manage that care. So I think life sciences is really, that whole field is ripe.
Okay, so you just won't take my fintech bait.
Well, I won't, but I'm going to give you one more because I'm super excited about it. The other area that's super exciting is self-driving cars. We have over 1 million people die on the road every year.
I rest my case. Yeah.
No,
yeah, right.
Okay, so if you want to go into, I'm sorry, if you want to go, I thought you were asking where do we use machine learning?
I want to ask the other panelists about fintech, and as I think I discussed with you, I mean the interest in fintech at Wharton is mushrooming. I should have mentioned some big thanks to Google for technology, of course. So you look great today. You always look great, but one of the reasons is that Google Meet is fantastic video conferencing. So thanks for helping us with that. And we're also live streaming this event on YouTube Live. I think that's part of your empire. So thanks very much for both of those things. Second question, I only have 3 for you. Second one is about the sort of, so we're talking lessons learned, but you know, you've gone from one coast to the other, from Wall Street to Silicon Valley. Any lessons you've learned in Silicon Valley that you think might have helped you when you were on Wall Street?
Well, probably the most important one here is the founders from the inception of Google were what I've learned to describe as they were deliberate about innovation. Even though we're in a super entrepreneurial environment, we've got amazing engineers, they never took it for granted. They always wanted to push people to kind of extend the frontier. And at the earliest days, many of you have probably read about 20% time, if you have a great idea, go off, explore it, use 20% of your time to pursue a passion. Out of that came Gmail and our first AR, VR headset. And so the notion is, if you're passionate about it, you either do it here and we give you the room to run, or you're going to do it elsewhere. But they were deliberate about innovation. The next version of that was they created Google X, which is what we call our moonshot factory, and out of that came the life sciences business and the self-driving car business. And I would say that Alphabet is actually the third iteration of just being deliberate about innovation. And so I think being deliberate, if we're focused on it from a governance perspective, I think it's a helpful reminder how important it is for each of us in any business, in any industry, to get people to push the frontier. I'd say that's probably the most important point.
Okay, so last one, and then we'll liberate you for your afternoon. I don't know whether you remember this. I remember it vividly. You had a lunch before the MBA ceremony where you were the graduation speaker with a group of our young women leaders. And you said something like, going to a big bank as my first job gave me fantastic training for life, even if you didn't want to stick there. Do you want to reflect on that a little bit? You know, we've got a lot of people who'd love to follow in your footsteps. Tell us about big bank finance and the business lessons that you learned there that have helped you in the rest of your career.
Well, I think there's another important part to starting in that bank. I actually started at Morgan Stanley right before the crash of '87, which was the single biggest one-day correction in the market. So I started and thought my career was probably over within 7 weeks of starting. But I would encourage all of you, go back in time and do a stock price graph, and you will see it was a tiny blip in history. And what was extraordinary being at a bank is, as markets evolve, new industries are created, it continues to create new opportunities for you. And so I may not have answered your fintech question directly, but I'll come back to it. I think finance training, the data analytics skills that I got at Wharton, the finance and accounting insight I got at Wharton, I was able to continue to apply across many different industries when I was at Morgan Stanley, and you can do it, of course, in industry as well. And so I firmly am of the view that if you go to a place that enables you to work with best-of-class clients working on the most important issues of our day, you're going to continue to grow and learn. And I would just encourage you to keep looking for that growth and learning opportunity. And absolutely, I think that starting at Morgan Stanley gave me skills that I can use for a lifetime, and the opportunity to see amazing business leaders in many different industries, which provided that pattern recognition that I've already talked about.
So congratulations on all you've done. Thanks for your time today. I think we've got to let you go. Thanks a million. Could you join me?
I'll be there for the 20th. Thank you.
Thank you. In a world in which technology offers so much promise, but we tends not to work in the execution, I hope that worked for you. It seemed pretty seamless for me. So it's fantastic that it worked out. Robert, let's now pivot to the carpeted area here. You were in the room. Anyone who does the Google search knows that you were in the room on the fateful weekend. Give us a feel for it. Did everyone know how big the things that you were considering? I mean, I guess it was pretty focused. Can we find a buyer for Lehman? The government's not going to buy it. Did you know how big a deal it was, or did it look much more focused?
So I think I'm going to step back and just tell you how we were informed. So we get a call. They called most people right around the close. They called me. I think I was the first call because I had to come from Stanford. And I think they called about a dozen of the CEOs. So it was more or less the 10 U.S. firms and then the 2 foreign firms, UBS and Deutsche. I was representing UBS. So you had JP Morgan and Citi and so on and so forth. And they just said, listen, you need to be at the Fed at 4:30. And so you walk into the Fed room. We did not know. I mean, listen, we were all having problems, but we did not know what the situation was at that time. And so we sat down in the room, and you see who's around the table, and, very different players today. And, John Thain was Merrill Lynch, and John Mack, Morgan Stanley, and Vikram Pandit was Citi, and Jamie Dimon, and so on and so forth. And all of a sudden, Paulson, who was the Treasury Secretary, Chris Cox was the head of the SEC, and Tim Geithner was the head of the New York Fed, walk in and say, we have till Sunday night to determine the fate of Lehman, and there will not be a government bailout.
So they said that on moment one.
Literally, that's how they walked in. And for someone like me, we're sitting around real rainmakers, and I will tell you, we all were, jaws down.
Now, before that, of course, in retrospect, people are second-guessing that by saying, the bailout bear stearns 6 months in advance. Did anyone push back on that? You should reconsider the government bailout part, or was everybody just accepting that and moving on?
There was definitely challenging questions of why, but that was not a discussion because they made up their mind because of the backlash that they had with Bayer. And so literally from Friday until Sunday night, I think it was the most collaborative, and I know you're going to get there on a question, but it was the most collaborative probably Wall Street has ever worked together, even though we failed at the end, per se. But because we're competitors all day, and unless we're doing some new issue together, it's very Darwinian. And
okay, but let's push on that. So it's collaborative. If I remember correctly, people were looking at Barclays. I don't know whether they were at the table.
They were not in the room.
As potentially the buyer. You're looking for value. Didn't Lehman wasn't there something in Lehman that was worth buying? Why didn't a deal come out over the weekend?
So just to take a step back, one, we were collaborative because we all knew what would happen Monday morning if Lehman failed. We were not collaborative because we actually cared about Lehman. We cared about the outcome. Okay, and literally we used to call it fixed bayonets. You protect your own castle. And so we realized that if Lehman failed, there would be incredible contagion, and we haven't had real incredible contagion like that ever. So why we worked together is we thought collectively we could split up a good bank, bad bank. We thought that someone would actually buy the good bank, and there were many different people we thought could go to, whether it was Buffett and Flowers, or Barclays, or B of A, a bunch of different players. And then the bad bank would be financed by us collectively. And we thought on I would say Saturday, that was the direction we were going. And then I think we came in Sunday feeling quasi-okay, and then it was clear that the FSA, which is the UK regulatory system, was not going to allow that to proceed. Because the truth is, what is a good bank at Lehman? You don't really know what was under the hood. No different than UBS. I mean, what was astonishing when I became the president of UBS, I learned that our balance sheet was $2.3 trillion and we were 55 times levered. Now, that was astonishing to me.
That's another one of the interesting stories that comes out, that leverage was higher on the European side. I mean, Deutsche was incredibly leveraged relative to the American banks.
I think and they still may be. That's where I would, in some ways, respectfully have a different view than maybe Ruth. My view was we did not have the tools in there to rectify the situation. And there is no question that AIG was the big elephant in the room. But unbeknownst to most, we could not talk about it because the Fed, the SEC,
not a financial institution,
the Fed,
right?
the SEC, and the Treasury were not the regulator.
Yep.
So that became why I became a supporter of Dodd-Frank, because it started with a systemic regulator. We could not talk about Fannie and Freddie in that room. Mm-hmm. So all of a sudden, yes, Lehman was one, but we were one of the largest lenders at UBS to AIG, and I know what we were going through with them. So as you know, looking backwards, there was a bailout of AIG, $185 billion, soon thereafter. So, long story short, it was probably the most surreal weekend, infamous weekend, famous weekend that I've, for the most part, ever been part of. But when we walked out of that meeting, we were not then collaborative, okay? We were then really going back to protect our own kind of house, and literally we did not have the tools. And that's really important. We didn't have derivative clearing. We didn't have a resolution authority, which is the whole idea of a living will. People say, well, we could have kept it going. Well, not really, because all the different countries were going to ring fence capital, okay, immediately. So there was no real way, without a government bailout, to truly, I think, keep Lehman afloat.
Okay, so that was then. This is now.
Yep.
You're no longer in a nice plush corner office in a big
Yeah,
bank.
I tell people, I answer the phone, this is Robert. They say, no, where's Robert?
Yeah, right. So the cliched question that I've got to ask you is, are we safer? And how do you, if you're asked that question, I know you spend a lot of time in the media. When you're asked that question, how do you answer?
Absolutely, because there was incredible leverage in the system at the home, at the consumer credit cards, and at the banks. At the end of the day, I am supportive that we made banks stronger and they took action to become stronger, because you need a strong financial system. The banks are much stronger today. Leverage in the system is probably 70% less. There is real underpinning capital, meaning equity, and we're just stronger for it today. And one of the biggest debates I've had has been about the Consumer Protection Agency. The Consumer Protection Agency did a lot of great things because it changed subprime. It changed the idea of how we educate people on student loans, subprime, credit cards. And so that was a good point. And I always say that, obviously, as you know, I was an advisor to President Obama for all 8 years. And at that weekend, it's well known, I was calling him because we were telling him what was going on, and we were doing debate prep with him at that time. But I think what is most fascinating is that these tools, everyone loved the Treasury blueprint, which was 100 pages. The reason people have such negative views of Dodd-Frank is because it's tens of thousands of pages. They've moved from a principle-based approach to what I would say a written approach, and Marc and Jamie will tell you better than anyone, the industry is too dynamic to think. You can write every rule of the road in a book.
Okay, so that leads to my last question, which then I think is a segue to the other side of the stage. I saw a fantastic graphic this week. So it had all the bank stock prices indexed at 100 on the Lehman day, and then they all go down afterwards and they've come back. But the coming back of the banks has been way under the S&P index, for example, maybe with the exception of JP Morgan. So banks haven't looked a good investment since. Did Dodd-Frank strangle banks? Ultimately, you said it made everything safer, but if you use stock price as an indicator, it doesn't look like banking is a very dynamic industry these days.
Well, I would say two things. I would say banking is dynamic. I don't think stock price actually defines, dynamism. My view would be when you cut leverage by 50 to 70%, and you're in a quantitative easing environment where, literally their assets are not gaining any real interest, then, and lastly, the whole lending capability has slowed down dramatically. It's tougher to make money.
Right.
So I would
low
just
interest rates, less leverage, no liquidity.
Correct.
Tough environment. Okay.
Correct. There's a reason I'm no longer at UBS. It was great years. Okay. But at the end of the day, I will tell you what the American banks did very different than the foreign banks. They went on offense quickly. They took their pain. They went on offense, and that's why today there are still issues at the Deutsches of the world, whereas the cities have come back stronger, the B of A's have come back stronger. I think one thing about the American banking system is they understand when you're on defense, you're losing. When you're on offense, you're winning, just to go back to my football days.
Let's talk offense with Marc Rowan. So I don't know whether anyone was in the room other than Marc, myself, and maybe Jamie. We had an event in New York in June when Marc was asked a question about the financial crisis. Now, he was a trooper that day. He just had root canal surgery and I think was chomping on Novocaine or something at the time. But somebody asked you, Marc, tell me about the financial crisis, and you said, best thing ever. And I think it was best thing ever for private equity. Do you want to share with the group it was a line, it was a headline grabbing line, but you wanted to make some pretty important points underneath it.
I take it in a lot of different areas. So first, it was sarcastic. It was meant not to reflect.
He's got deadpan delivery, of course, which of course made it challenging.
The difficulty that everyone had, but I start really where Ruth started. And I'll give more history. I graduated here 84, 85. I went to work at Drexel Burnham, and Valentine's Day 1990, I carried my belongings out in a cardboard box a la Lehman, and 1990 was another financial crisis. And I thought, joining and graduating at 84, 85, that every good deal had already been done, and that I was just 5 years too late. Every time you get a financial event of the scale of 1990, 1987, or the financial crisis, everything gets reset. So if you're a young person coming into the business, it really does clean the slate and allows you to start over. What I was talking about was really the effect on the industry. So I'll pick up where Robert left off. If you're a bank today, it's harder to earn returns because we've been through and are still in a decade of financial repression. Very low interest rates, lots of liquidity. If you're a bank, you make money earning spread. You can't earn as much spread, you can't have as much leverage, you don't have as high an ROE, your stock doesn't trade as well. Those be the facts. But if you think about what happened in the financial crisis, the thing that was available at that point in time, the thing that had caused, first the center of gravity was the mortgage crisis, but credit was what was decimated. And so once you got over the shock of what was decimated and institutional investors started looking around, they saw this opportunity in credit. And they really were no industrial strength credit managers. And credit is a bottoms-up, security by security, company by company, industry by industry process. It's not Fidelity, PIMCO, BlackRock, Western, DoubleLine. And they found Apollo. And Apollo went from managing circa $10 billion in credit pre-financial crisis to managing $200 billion in credit.
And that was because you didn't have the same kind of calls on the cash as a bank would? You're not being marked to market? What's the story there?
It's a lot of reasons. One, we had the core skill set. The second, people need yield. I mean, retirees need yield. The fundamental job that we have, that Jamie has, is we try to get our people focused. We provide fiduciary returns to retirees. And that's what we do. And they come to us because we offer greater returns. So you have banks who are playing defense and not lending. You have regulation coming in and pushing banks out of a whole bunch of businesses. You have a regulatory environment where the best people, in some cases, no longer want to work in a banking environment. You have investors who need yield. And we got organized very quickly and through a variety of mechanisms and structures built a credit business, and we're not the only ones.
Right, so I think that's also, this is just a fascinating story. Back then, there was a really narrow understanding, maybe not definition, of what private equity was, right? This is a leveraged buyout was what private equity was. And you've been saying to me for years, you know, when you think Apollo, we're an insurance company, maybe a credit company. When you think about Blackstone, Blackstone's the largest real estate investor in the world. Big stories about corporate lending now being done by private equity firms. And then, to my mind, a really striking thing, BlackRock said last week, you know, there's not enough return for us in the public markets, we're going to have to do private equity. Two questions about that. How do regular folks get into the world of private equity?
I think asking about private equity is almost the wrong question, and I'll take it a little more broadly. So if you think about
private markets, not publicly traded markets.
So it's a tough problem, because if you think about what's happened since the financial crisis and financial innovation, one of the big untold stories is ETFs and passive investing. A massive amount of the equity markets and the credit markets are now in the hands of liquidity-driven investors rather than credit or fundamental-driven investors. So a liquidity-driven investor buys when they get cash and sells when they don't have cash. If you're a fundamental investor and you pick a stock and it is not part of the index, it's generally not going to move. It's unclear to me that fundamentals in a short and medium term will be reflected in value of securities prices versus liquidity and indexation and everything else. I think that destroys a lot of value. A lot of buy-side money focused on fundamental investors has moved out of their hands and into the hands of ETFs. Research analysts are out of jobs. Other sort of buy-side analysts are out of jobs. So if the buy-side was where regular folks went to go get access to investment alpha, investment DNA, I think it's getting harder and harder because the industry is getting indexed. I also think that one of the outcomes of regulation in the financial crisis and Dodd-Frank also removed dealer capital from the industry. It used to be that securities firms and banks made markets. They were the break, if you will, between buyer and seller. Now imagine the setup that we have today. You have no break between buyer and seller because there is no capital in the securities trading system. And you have an indexed market. And so if you're a regular folk and you participate in public markets, you are almost at the mercy of liquidity. In a liquidity-driven event going up, it feels great. I think in the next downturn, I think it's not going to feel so good. I think we've actually taken steps from a regulatory and structure point of view that are going to exacerbate movements down in price.
Okay, so
makes it tough.
Important questions. Some of those I want to follow up with Jamie in a second. But you know, the last obvious question for me, maybe it's too simplistic, is you and other players have taken enormous advantage of this environment since 2008 to do extraordinary things. Is your part of financial services getting too big? How would we know when it's too big? Should we think about more systemic regulation extending to your part of the financial world?
We're essentially there. I mean, we are regulated as an insurance company. We're regulated in almost every jurisdiction. The fingerprinting ink is barely dry on my fingers from the last time I've been fingerprinted by a regulator. But I think Ruth made an important point, and Robert made the same point. You go back to the fundamental equation of assets equal liability plus equity. And you get a financial crisis when you have a liquidity run or a liquidity draw. And so long as your assets are ultimately worth more than your liabilities, you will find someone to bridge that liquidity. unless your assets are too hard to explain or they've declined in value, in which case the entity has to be taken over or restructured in some way, shape, or form. I think that what you're seeing for the most part in the alternative world is an outsourcing of senior secured credit, and the liability side is investors, meaning that while there may be losses suffered if we do a bad job, I don't think it is the same systemic risk to the country, because you're not talking about 55 times levered, you're not talking about guaranteed, you're talking about investments in the hands of investors who either are prepared to experience loss on a temporary or a permanent basis, or have a time horizon where the mark-to-market on their securities on any given day just does not matter.
So university endowments that are seeking return, it makes sense for them to be invested in alternatives. You're saying it's dangerous for individuals who might really need the cash to play the alternatives game.
I think that's true, and I think it's... I also think that it is very psychologically difficult. If I look at my career, which is now 35 years, it's been interesting, but for all the success that our firm has had, we made most of our money in 8 years. If I was really, really good at my job, I only would have worked 8 years. Unfortunately, I came to work every day because I didn't know which 8 years, and the reality is the secret to success in investing, for the most part, is low price. You tend to get low price when you have financial chaos, and that is exactly when most people don't invest. Particularly regular investors, they tend to invest when there's been an era of very high returns and they're watching their neighbors get rich. And so I'm not a huge fan of regular people and alternatives, because I think that the expectations are not where they should be.
I think that's a really important point. Back in a Keynesian kind of counter-cyclical sense, what you're saying is that alternatives are counter-cyclical, which is really helpful to the system in a world in which everything else is riding the cycle. Jamie, we're going to go to a lightning round after I've done the tour of the semicircle here. But for you, Jamie, let me ask you a sort of a personal hedge fund industry question. Hedge funds did extraordinarily well after the crisis. Did you anticipate that?
No. Not initially. In fact, initially I was of the view, as we came into the end of 2008, early 2009, that we were looking at more existential issues that had, shall we say, not very pleasant endings. To give you an example, I remember it was January 2009, I was home. I had a colleague in my London office who was from New Zealand, gave me the name of a broker in South Island. I was looking at places to buy in Queenstown.
This is the end of the earth, by the way. You can't get any further away than the South Island of New Zealand.
It's a true story. Okay?
It is beautiful as a result, but this is the end of the earth.
You got to hedge yourself. And so I'm looking, and my wife comes by. She says, "What are you doing?" And I said, looking at real estate in a place called Queenstown. It's supposed to be quite nice. She goes, why would you buy a place in New Zealand? I said, well, in case you have to make a run for it. And she says, you've lost it, and walks out of the room. So I'm sitting there looking at my screen going,
you should have said it's one of the most beautiful places on earth.
It really is beautiful. I've never been, but it looked beautiful in pictures. And so I'm thinking, yes, she's probably right, I've lost it. So I would have made money if I had done this, by the way. What's interesting is it wasn't until the beginning of March 2009. Remember, it was the first Friday in March. The banks, okay? I remember Citi and B of A. That afternoon, Friday afternoon, both increased like 40%, in the last hour or two of trading. Now they went from 60 cents to 90 cents a share. And I thought about over the weekend, and I remembered in 1991, Marc actually referenced the 1990 crisis. In January 91, everything was horrible. Every bank in the United States, probably other than Wells Fargo, truly mark-to-market, was insolvent. The Gulf War started, and all these banks that had gone from $100 a share to $8 a share started to rally. And I think this is BS. This is a head fake. And I was short them, so full disclosure. And I'm not the senior partner in the firm, so I'm getting yelled at, okay? You know, I was a hero from the 50 down to 8, but now 8 to 12, I'm a loser, okay? And I'm going like dead cat bounce, you know, head fake, you know, these things are all solid. Well, needless to say, about a week later, now they've doubled. And they, you know, I remember my senior partner basically covers them. And I'm like, that's the dumbest, you know, buy I've ever seen in my life. Well, of course, these things all went up 5x over the next few years. And that weekend I was thinking, I was like, when the dead start walking, that's when you guys start paying attention. And that Monday I came in and we basically went from totally almost risk neutral to basically totally risk engaged. And I remember after 2008, we thought it was going to take a couple of years to make back our losses. So anybody who was in a mark-to-market, you know, business lost money in 2008. We were no exception. And we actually, by the end of the summer, we had made back all of those losses. But the other thing that helped, and Marc kind of alluded to this a little bit, was it's not enough to actually have conviction. You have to have liquidity. You have to have the ability to do it. And I remember going into, you know, that weekend of Lehman Brothers, September 12th or so, I think it was. And, you know, we're not the smartest guys in the world, but we're not the dumbest guys either. And we were 100% convinced that Lehman basically, you know, wasn't solved, okay? And after Bear, right after Bear, we went through all our counterparty exposures. The counterparties where we had exposure if somebody, you know, actually blew up. And we got out of Lehman, we got out of Merrill Lynch, for example. We were, all due respect to Ruth, we were nervous about Morgan Stanley. We had a really good relationship with them. We stayed in Goldman, we stayed in Deutsche. I thought the German worker would bail me out. We were not in UBS or Credit Suisse because we thought the country was too small if things really got ugly.
We were bigger than the country.
Okay, we were bigger than the country. We were in Goldman, but we didn't realize that Goldman's Achilles heel was AIG. If AIG had gone, Goldman was going, and actually we were all probably going as well. When you wonder why not Lehman and why AIG, as Dick Fuld often talks about. So I roll into that weekend, and just like a little backstop, one thing I've learned in investing is credit investors smell the fear before equity investors do. For one simple reason, in my opinion.
Always.
They don't have a lot of upside, and they got all the downside. Equity holders are always dreaming and thinking big, and they got huge upside and huge downside, and no one wants to leave the party early. So the cracks in the system really started almost 16 months before, when Bear Stearns, a smart firm, basically mortgage funds started to implode. And so we were really coming into Lehman, we were cautious at York. When basically the thing fell apart, and full disclosure, we were 100% convinced they were going to bail them out. Okay, I remember coming home Friday night, you know, there's no way they're going to let it go because there's too much damage. Well, they let it go, and everybody blamed the Brits a little bit, but a little bit, you know, you have to say, you know, John Thane, you know, walking out of the room, calling Ken Lewis at B of A, which was a potential buyer, and saying, hey, I'm a better-looking bride than Dick Fuld, and, you know, Lewis agreed, and, you know, so no matter what happens going in, Robert made a good point, like, you know, Sunday morning, they probably thought they had a deal, you know, Sunday night, everybody was back home trying to protect themselves. I still think, though, that while Lehman was incredibly devastating to anybody mark-to-market, I really think the real contagion started the next day when a really little-known money market fund called the Reserve Primary Fund blew the buck. And the Reserve Primary Fund basically took institutional capital, not individual capital, and basically everybody had their money in money markets. Certainly individuals did, and corporates. Think of it as like an overnight kind of a repo type market. And everybody thought the principle was sacrosanct. And there have been a couple situations in years gone by where big mutual fund companies like a Fidelity of the world had a fund that might have broken the bank, but the parent company made it whole, so you never thought there was risk. It was almost an implicit insurance. Primary Reserve, which was a mom-and-pop operation run by a father-son team, either didn't have the money or no interest dipping into their own pocket. The buck broke, and the contagion was almost instantaneous. Third-party repo pretty much collapsed 24 hours later. You talk about what happened in Australia. It was basically overnight funding markets collapsed. And really, Robert can give you the exact days better than I can, but my experience was within 3 days, nobody trusted anybody else's collateral. Nobody trusted anybody else's collateral. And all of a sudden, within 2 weeks, even guys like GE, I think we had our first big public policy conference that Marc really hosted a few years ago. Jeffrey Immelt was our keynote at the breakfast, and he said, you know, he woke up basically 10 days later and realized he was going to have trouble making payroll. And he swore that would never happen again. And this is the time when GE was the largest and probably the most powerful company, you know, in the world. And that's how quickly it was. So fast forward, we at York are easy and pretty quick to run for the hills when things look ugly. And that's exactly what we did. So we didn't wait for the, you know, basically all the policy responses not to work, all the contagion slowly take place. And so we basically, you know, really took all the pain in September. I remember looking at our P&L. We lost most of our money in September. You know, we lost probably 12% or something, which for us is a huge loss because we came in with cash and we came in with hedges. The market itself really rolled over between, you know, basically October and early March. By that point, we had almost no systemic beta in the book. We were 68% in cash. So when I wanted to go engage, okay, I had the money to do it.
So was that true of the, I mean, you're a smart guy, was that true of hedge funds writ large, or did we only see the success hedge fund stories and there were a lot of bad news stories?
Hedge funds are a big group,
yes.
So are private equity, so are banks, okay? A lot of banks are no longer with us, okay? A lot of private equity guys are no longer with us. Basically, it's a Darwinian world. The smart guys ran for the hills, had dry powder, and ultimately realized, you know, at some point, the world was not coming to an end. To me, when the banking system started to come back, that gave me the green light. It's time to, you know, get more long systemically. I didn't do it overnight. It was probably a 8 to 10 week gradual re-engagement process to get back to fully invested. But I think the good guys did. I think in hedge funds, I think the hedge funds that came back were the ones who treated their investors fairly. They didn't gate, suspend, say you can't get your money back. Most of those have either reinvented themselves as something else or, you know, they've joined the history books. You know, Marc used this term, you know, taking advantage of chaos. And, you know, there's a very, very famous expression, I hope they still teach it at the Wharton School, which is the best time to buy is when there's blood in the streets. Supposedly, you know, Lord Rothschild said that. And that's sort of true, but it's not completely true. The best time to buy is when the blood is in the streets, but not if it's your blood, okay? And thank God for me, it wasn't my blood anymore. I took the bleeding in September. My wounds had healed, the scab had fallen off. And so I actually, by then, I was in a completely risk-neutral mode, whereas if you'd asked me 3 months before, I was in a much more risk-averse mode.
What's the flip side? Are you just saying logically, when there's all this momentum now in the public markets, no surprise that hedge funds in relative terms seem to be doing less well? You think that's just a natural process? I mean,
No, not at all. I think you know, I'll take the credits, I'll take the blame. I think a few things happened. A lot of money flowed into hedge funds, in part because of that relative outperformance and the relatively more quicker re-engagement. I think too much probably, you know, came in ultimately. Too many people were chasing the same stuff, particularly in equities. Things got crowded, and when you saw risk went off, you know, all your risk models ended up being off by a factor of, you know, quite frankly, about 75%. In other words, you thought you had beta 1 exposure, you had beta 4 exposure on the downside because of the crowding effect. So we, you know, made some of our own mistakes. 2015 was the big year that, you know, one would focus on. I think, though, after that, what you've seen is, and I don't want to get into a big discussion on QE, quantitative easing, and the unintended consequences, but in hindsight, what QE ultimately did, QE is basically just flooding money into the system, is it took out all the forest fires becoming basically contagious or basically huge. And so every time there was some kind of threat to the system, a risk could go off, the central bank saved the day very quickly. Brexit was a great case in point. The UK votes for Brexit, no one's expecting it. For the next 3-4 trading days, everything in Europe is basically in free fall. The ECB floods the system, and basically a month later it never happened. And that didn't happen in the old days. Okay, and so the central banks, once burned, are now basically engaged, or they're trying, to be engaged. They don't want to go through what they went before, and that's further compounded by the fact that they no longer had any tools. Now they're trying to get those tools back, but basically back then they did not really have that many tools. I think, though, and I lived through this from '95 to early 2000, where beta was your best friend. Okay. The S&P went up 20-some-odd% every year in that period. And we had hedge funds, we lagged. I remember I had some investors who said, why should I pay you, 2 and 20? I'm getting better returns at Janus 20th Century Fund, which he was, okay? But from March 2000 to, let's say, the end of 2001, I probably generated something like 25% net returns, and he lost 80% of his money, okay? So, you got to be a little bit careful about just being long systemic risk. There is a business cycle, things do go down, although it doesn't seem like it'll ever go down right now. But this massive amount of money that's going into passive investments, ETFs, all this is basically making passivity, and beta a self-fulfilling prophecy.
Yes.
And it's a great party while it's going on, but all parties do end.
Okay, so that, clearly, if we look at big trends since the crisis, the rise of BlackRock and Vanguard, right? It's there. It's there in the numbers. There are a lot of zeros. Is that part of the market too big? Does it create opportunities for you? Does it make players like you more important?
I don't know if it will ultimately create opportunities when they throw the baby out with the bathwater. Right at the moment, it's from
which they have no choice in not doing. That's a double negative, right? But their rules are telling them that they mustn't do that.
Yeah, but as long as everybody feels good, the risk gene goes into kind of remission, and no one wants to miss out. And so I think right now it's difficult for any fundamental investor, I think equity or credit, to just buy generic product. I think you have to either create your own product, or you got to basically move into places where the liquidity guy isn't driving pricing.
This is a huge deal. From our point of view, this is, for us, the fundamental strategy. In the private equity business, how do you avoid the liquidity-driven buyer? And there are lots of good examples, and I'll come back to. But even more important in the credit business, and it's forcing us to really remake the entirety of our business from a markets business to an originated business. And you come into our organization, and in one corner is the aviation finance team from Citi. Over there is the mortgage finance team that used to be at Deutsche. Then there's the longevity and mortality team that used to be at Swiss Re. There's been a sea change as to where this investment DNA lives. And it's not only in our firm. It basically has left many of the places it traditionally resided. And we are in a race to really remake our business because we don't see alpha in CUSIP securities.
One big theme I get from you is from you both really is that what's another way to describe a liquidity-driven investor? It's an individual who needs the money. So you're saying it might actually be good for individual investors that they don't get to invest directly with you. It's coming through other entities. A very important point. Let's pivot now. Thanks for going around the table. Let's make it more free-form, and I encourage everyone to jump in. When we're asking people to register for this event, we ask them for questions that they'd like you guys to respond to, and people came up with some great ones. No surprise, there was a whole bunch of stuff about careers. And let me see if I can ask the career question in a few different ways. The first one is, sort of rise of tech, decline of traditional investment banking, etc. How attractive is a career in finance going forward, and what does that career look like? Who wants to go? Jump.
I'll start. I mean, you know, we talk about how markets go through evolution and change, and I think careers go through evolution and change. And when I graduated here in 1981, Wall Street was a very, very different place, obviously, than it is today. But I think, you know, there's always opportunity in finance, okay? The cycles change, people come, people go. Careers tend to be a little shorter, so it actually creates more opportunity in many ways for new people coming in. What I love about finance is the following. I think it's still very complex. I think you're at the epicenter of all the really interesting things that's going on in the world, whether it's business, politics, valuation, and everything else. We've seen this huge marriage of, I think, finance and technology. Ruth talked, a lot bit about it. I think most of you in the audience know more about it than I do. But that's a brave new world, in my opinion. It's a world where people in your generation have a huge advantage over people in my generation, and you can take advantage of that. And then lastly, in the just traditional investing, field, one thing I've noticed is today it's a lot harder. Okay, it's a lot harder for lots of reasons, and let's just put it down to it's a lot harder because everything's more efficient. But if you can find ways to make money, okay, in this environment, really actually create alpha, you are so much more valuable today than I was, because anybody could find alpha, 30 years ago, or not anybody, but most people could. It wasn't that hard, okay? Today, if you can find it, you're so much more valuable. If you're really talented, the alpha's there, and I think you'll actually find it to be an amazing career.
Okay, so Robert, you were, as you alluded to, you spent a lot of time with President Obama thinking about big economic policy issues. Obviously, one real concern is about automation technology and impact on work. So we used to think that only happened in the low-tech, low-skilled world, but then we have lawyers being disrupted by machines that can search precedent more effectively than humans can, and things like that. Does technology mean that finance as an industry, as an employment vehicle, is bound to be smaller going forward than it's been historically?
I don't think so, because I think as long as GDP around the world continues to increase, there's going to be capitalism. And one of the greatest things about this industry is there's tons of smart people around. And it can be whether it's fintech, or it can be private equity, or it can be plain banking. At the end of the day, as long as money's moving and origination needs to happen and people need to raise money, there's going to be a financial industry. Here's the way I would say it a little differently than Jamie. So, and I mentioned this today earlier at lunch. At the 25th year in my business, when I was recruiting on behalf of UBS at a place like Wharton, people would say, would you do it all over? And the way I would say it is, if you can be in business for 25 years and 80% of the time, okay, your year is great. And 20% of the time. So 5 years of my 25 were terrible. But I would sign on the dotted line again at 21 if I knew that 80% of my career would be great. So what makes a career great? Are there smart people around you? Do you have the ability to grow? Are you being paid fairly? And are you growing in your profession? I think with Jamie and Marc, we all kind of stayed in a profession our whole life. The students today, it's going to be more of a sprint than a marathon. So at the third year or the fifth year, they may decide to do something else. What I would say is finance as an industry, the game has changed, but the idea of the importance hasn't.
Okay, so Marc, you wanted to respond to this. Can I ask you a question about the kind of people you like hiring?
Sure.
So I'll give you two versions of this. One version is everybody's got to be a data scientist. What you need is engineers from Caltech. The other version that I heard John Gray from Blackstone articulate at our Wharton Forum in New York in June went the other way. He said, hey, we can train people in the technical skills. What we need is creativity, people skills, etc. So John's very proud of the fact that he did English when he was at Wharton. Right. So what are you looking for in talent?
Look, it starts with brain power. It starts with pure, candle power, and that is not enough, unfortunately, because there are a lot of really smart people. The question is, can they grow into being client people? Can they sell? Can they convey an idea? Can they actually take a blank sheet of paper or a blank screen and make something happen, which gets to creativity? The things that John talks about, you can't deny those are the things, but that's what creates leadership and success. I think the prerequisite is candle power. And I'll kind of tie both of these two together. When I started and made a choice in '84, I couldn't envision an investment bank being public. And I was right, because an investment bank in 1984 could not have gone public, but Goldman Sachs doesn't look anything like what it was like in '84. We now have 10 alternative investment firms that have been public in the last 6 or 7 years. I tell all my partners, I tell our employees, we, as an industry, will change more in the next 5 years than we've changed in the last 10 years. So for students to come out stuck into private equity is the path to this, or hedge fund is the path, they're kind of missing the point. By the time they get to a point in their career where they actually can exercise some of the John Gray, attributes, the industry is not going to look anything like what the industry looks like today. They should come back to where Robert is. Am I working with really smart people? Do I like what I'm doing? Is 80% of the time, boy, that's a pretty high percentage.
Yeah, I only used the first 25 years.
And look, these are hard jobs. The way you get 4 years experience in 2 is you work twice as many hours, and there's no denying it. And people, anyone who thinks that there's an easy path to this is fooling themselves. If you don't actually really love what you're doing, it's a really long sentence.
Jamie, where are you on technical chops versus leadership, creativity, judgment?
I'd like to answer that indirectly by starting with my soundbite I wanted to throw out after Marc's comments, which is what you're really looking for at the end of the day is who's willing to work really hard, because it's really hard, okay? The real world is not as, I would say, intellectually hard in many ways as the academic world, but basically in terms of your life commitment to it, it's much harder. And it's not 4 years, okay? It's more like 14 years before you're really going to kind of be in a position where you can be John Gray, or even start to think about, being John Gray. And when I look at the people I know who've been successful, the single number one trait, this is not just for finance, this is almost every CEO I know, they work like a dog. They work like a dog to get to a position where they basically then had a shot. And it's definitely true for me. I think it's definitely true for everyone here. Robert talked about the 5 shitty years, I guess. Everybody's got those crappy years, okay? And they can be internally induced, they can be externally induced. I remember, I remember after the market crashed in 1987, Ruth talked about it. It was right after she started working at Morgan Stanley. I remember after that market, I sat around with a whole bunch of my friends. We all worked at hedge funds at the time. We called them risk arbitrage funds. And everything was a disaster. A few of them were going back to business school to get their MBAs. And I'm so depressed because I already had my MBA, so I couldn't go back. And it was that bad, okay? I think it really, really, really helps to be comfortable with numbers at the end of the day. Being technically savvy is a plus, but if you're really good with numbers, if you basically have just a quantitative, I would say, comfort zone, you can learn whatever you need to know technically, okay? You don't need to be the next Larry Page in this industry. But you also, I really think, have to have, I think everybody in this room, passes the IQ threshold by, several sigmas. But you also have to have a little bit of what I would call EQ, okay, out there. And EQ is important all through your career. It's not just when you're the big shot and you have some kind of emotional connection. I promise you, when you're young and you're moving your way up, if you don't have EQ for your peers, for the people who work underneath you, as well as the people above you, it's going to be noticed and you're going to be penalized. how you treat people, how you interact with people is really, really important. And that doesn't come from IQ or technical skills. No one wants a jerk, okay, in their office. No one's going to basically cover your back if you're a jerk, okay? No one's going to basically say, this guy at the end of the day doesn't have it, and say, well, we'll take him till we max out. No, you're going to be basically moved on. And I think that's something all of you need to think about.
Okay, just to add, because I think it's.
We need to move on from the words.
Go ahead, then I won't add. Nope.
Add quickly.
Well, I would just say that when I was being interviewed, they said, what are you looking for? And they said, we're looking for a rocket scientist jock. And I remember answering, I have a Wharton degree and I played football in one of the two. And I said, what does it take? They said, we want to make sure you beat your boss in every morning and you leave after him. And so it goes back. It hasn't changed the idea of hard work. It just hasn't.
Okay. FinTech.
I know you love that answer.
Well, look, I just feel inadequate on the stage. What can I say? I mean, that's just the reality of my life.
Well, you have got tenure and
you never do anything.
But you have the tie on.
I know I have the tie on. By the way, I was going to take my tie off, but it holds my mic really efficiently, so I kept it on. Let's talk FinTech for a second. Everybody uses this term. I'm always trying to figure out what it means. Anyone want to give me a definition of FinTech?
Definition hard. I'll talk to you about what we're doing, and then I'm sure it'll open up.
Can be in the eyes of the beholder. I think that's the point these days.
So if you think about where credit originated, particularly dispersed credit like a credit card or a mortgage, it typically originated in a bank. That's where you had your relationship. That's where credit work was done. And all of a sudden, you have a bunch of young companies coming up which are cutting out the bank, the finance company, or the other credit intermediary, and they are using data to underwrite you and prove that you are, and hope that you are a better risk.
So this is a SoFi kind of
It's
move.
not just SoFi, it's GreenSky, it's SoFi, it's a variety of direct-to-consumer where the consumer now has more privity with the money source than it ever had previously.
And they want to know more about your life, right? They want all these data points about your life.
You actually don't have to tell them anything because they know them already.
Know it.
Mm-hmm.
And so where does FinTech begin and end? So the fact that you can harness that data and that someone can interpret that data to make a credit decision, that's FinTech. The fact that they now have all this data and you're scared to death that they had all of this data, and so now you have to work for a solution to figure out how to protect that data, I think of that as FinTech. For someone like us plugging into this, we are interested in credit investing. These firms are interested in technology. We marry up our balance sheet and our willingness to put out credit with their willingness to churn the customers and figure out who's a better risk. So they're actually lending our money, if done well. So I think we're at the very, very early stages of FinTech and data interpretation. And then you go to the next stage of it, which is now you look in our PE business. In our PE business, I don't think there's a single company that we own where we have not, as part of our diligence process or our post-deal execution, brought in data analytics. Data analytics is a huge part of it. What we used to think of as marketing is now data analytics. What we used to think of as inventory efficiency and measurement and working capital, it's data analytics. And we're still at the early innings of this. And so is that FinTech? That I don't know. But I think I don't know that our industry is going to be the creators of FinTech. I think we will be very creative at how we use FinTech.
Okay, so the other end of the spectrum, ask you this question, Jamie. Cryptocurrencies, et cetera. Is that, you can construct either just a really nefarious story about cryptocurrencies and their modern tulips or worse, but you could also say, hey, there's something big about distributed ledger, blockchain. There's reasons to have currencies not tied to units of exchange, not tied to national economies. How do you feel about crypto?
Okay, full disclosure, I don't own any crypto, and I never owned any crypto. And so I kind of both missed the rise in the recent severe correction. You're listening to a guy who was never a gold bug. I always kept thinking, how are you going to move all that gold, okay? down the street when chaos, reigns supreme, because at that point it's the guy with the gun who's basically going to control the world, not the guy with the gold. Sometimes wonder, so I find it hard to buy into this. I think it's an interesting trading currency. I'm not one of these survivalists, that basically, governments are evil. We need to basically have a mechanism to store value that we can move independent of government control. There are people like that. I think some of that came out of the financial crisis. It's almost like offshoot of populism. But the other problem is when you think of ultimately crypto, and I'm not talking about the blockchain. I think blockchain technology is probably a huge area. It's going to continue. It's going to disintermediate lots and lots of industries and businesses. But I keep thinking but there's infinite amounts of algorithms that one can come up with. So why is there why is take Bitcoin as a well-known one? Why is that going to be the U.S. dollar? Okay, but remember, before the U.S. dollar, there was the cable, basically the British pound. Before I go way back, there were the Roman, iron coins. Okay, so there's no such thing as, I think, a long-term, true store of value. Maybe other than gold. Okay, seems to have defied, the centuries in that regard. So I'm not a fan. I think you can trade it and play with it, but when the shit hits the fan, it's not going to be worth anything.
So fintech question here. You move, I think everyone has to be responsible for moving money across borders. That looks like a system, the system that's sitting there, SWIFT and these other things, are so old and look kind of pretty inefficient as a result. Is that an area where fintech can have an immediate synergistic impact on finance, on traditional
Robert
finance?
would know better than I would, because you should be able to fix the SWIFT system to be a little bit more user-friendly and move more than, and do it more than a day, or take 2-3 days to move money off. Most people who are using crypto are not doing it to avoid the delays in the SWIFT system. They're doing it because basically, it's not either the destination or the origin of the money is not exactly going to pass, shall we say, regulatory scrutiny.
So is that a big deal? The frictions moving across currencies, and is that an obvious area for fintech to take hold quickly?
Well, one, I just want to. I'm on the other side of Jamie. I actually think crypto is a real asset class. Okay. I think there's going to be an incredible growing population of this whole libertarian movement.
But you think for political reasons, not for economic reasons?
I think for economic as well. I think, in my opinion, something like post-Equifax makes people feel like these decentralized ledgers make a lot more sense. So that's one. With respect
to... you don't need crypto to have a blockchain.
Then I was just going to say, with respect to blockchain protocol, I actually think with the whole administration aspect, legal agreements, audit, accounting, financing, it's going to change all of back office completely because it becomes more efficient and you actually can move to best practices very quickly. So for me, I'm the opposite. I'm an investor in both blockchain protocol with respect to those type of underlying platforms, as well as I just think playing in this crypto is I think eventually becomes an asset class, because I think really wealthy Wharton individuals will say, I want it part of my asset class, because I actually think that it's going to grow, not actually shrink.
So do you think it'll stay outside the system stay outside the system or get insourced eventually? The big players will bring it in.
I think eventually it's big players are going to bring it in because I think it will become more common. I'm not saying the pricing today is the pricing of the future. I just want to be clear with that. I think it's all speculative today.
I don't want a free ride on both of them.
Go ahead.
I'm much more where Jamie is. I think blockchain and Equifax is the perfect example. Medical records another great example. Right. I think we're going to see lots of blockchain. Yep. I'm a huge skeptic on crypto. Remember, the environment we're in is a really benign environment. This is like everyone's getting bailed out of everything. There's liquidity everywhere. The markets keep going up. We have yet to suffer real reversals where people need the cash. Crypto is not immune from that. They have not seen a real crisis
I haven't
yet.
seen a downturn. We've got 4 minutes 15 to do two big questions. One's about the ethics and finance question. I want to ask it in a pretty focused way, maybe not a traditional way. And then next crisis, what keeps you up at night? So 2 minutes for each. So one thing that we've seen since the crisis, obviously, is tying compensation for executives much more to performance and to longer-term performance, longer vesting of stock options and the like. But I think people, regular people, say the problem with the finance industry is you get a lot of the upside and you don't bear the full downside risk, which was why there was all this throw them in jail stuff after the crisis. Is that a structural issue that it's impossible for people in financial services to bear the full downside risk of their actions? Is that a big structural issue?
Yes.
Yes?
I don't think it's impossible for people to bear the full structural impact of their actions because the scale of business that is being run is just way beyond.
Okay, so what do you do about that, Marc? Is there anything you can do about it?
It's incentives. I mean, I do think that we have an easier time. Jamie has an easier time. Picture our compensation system as the donkey with the carrot just in front. It's a really long-term compensation system. You are tied to performance, and you're not tied to performance today, tomorrow, this quarter, or this year. You're actually tied to the realization of the investment that you made. And whether the market goes up, down, or sideways, or you did a good job but the market went the other way, you just suffer the consequences or reap the rewards side by side with the investors. I think that is a good way to do things. Plus, you have your own money invested. And you never get enough money off the table until you're 14, 15, 20 years in. You're always reinvesting what you take, and that is the culture of our business.
That's culture. Do you think that should be a regulatory requirement? Is it a regulatory requirement?
It's not a regulatory requirement. For us, it's common sense in that we want people's outcomes tied to the client's outcomes. I think that we are also willing to suffer way more volatility up and down that is not available in a regulated institution. They don't have the same opportunity, and I think it's very hard to have them suffer the same consequence and still get talented people who want to work there, because we can make people fully responsible and ultimately not get really talented brains to go to work in these companies.
Yeah, I would agree with Marc. I was always one of those supportive in having people get paid in performance, longer vesting periods. But what we found at the Wall Street firms is good people would just leave because their equity in a down market would go down X amount, and then all of a sudden they became free agents. And there was always a next great bid for a good performer. So, unfortunately, on the finance side, there's a lot of people who are more mercenarial. It's kind of like, what did you pay me this year? And then at the end of that year, I start again. And I don't think you can do it in a regulatory environment, but I think the whole industry has to come together on a payment system that actually is not differentiated. So therefore, people feel like, okay, I'm not going to be jumping around on every bad cycle.
Okay, so last question, sort of a riff on the what keeps you up at night. How are you all sleeping? If you're waking up with bad dreams, what do they look like? I mean, we're living in an environment it's been a long upside to the cycle. All good things have to end. Everything looks expensive in the markets. What are you worried about?
Well, first of all, I sleep pretty well these days.
Sleeping well?
Sleeping well.
Good.
Sleep well.
Good.
Helps being, successful to sleep well too. But my ditch digging days are probably over. Although I have a few days in my career where I wish I was a ditch digger. So, there's always risk. Okay, and I'll give you one or two at the moment that I do worry about, and I worry about them enough to where I have real specific hedges, in my portfolio. I call tail risk kind of hedges. But I will caution that historically I have found most of the risks that have really ultimately come to be really dangerous, you don't really see coming, which is what makes them really risky. And Lehman was a risk I saw. The collapse of third-party repo was a risk I did not see. Right now, I think the situation in Europe is not very healthy. I think the third largest economy in the Eurozone, Italy, is undergoing a populist movement that could really lead to potential unraveling of the whole Eurozone. The ramifications there would be too big to fix, quite frankly, and you can actually hedge it out pretty cheaply. If you are worried about it, I have a lot of exposure newly, so I have hedged it out. You could have hedged out Lehman Brothers pretty cheaply, well, until about a month or two before that thing, went to zero, as well. So that's number one, and probably number one. I think number two is kind of goes back to things we've been talking about in this discussion: the rise of ETFs, the rise of passive investing. I worry less about passive investing in the equity markets. Equity markets clear pretty quickly. You may not like the price, but they tend to clear. Historically, they have. Credit markets, on the other hand, don't tend to clear very quickly, and they tend to be much more sticky and much more painful. I think a lot of practitioners who have pushed ETFs in particularly non-investment grade credit product are creating the next real panic. These are basically individuals who own this stuff. They're looking for yield, as Marc talks about. But basically, there's structure determines behavior, and behavior kind of determines structure. And if you have, a structure where the guy who gets out first lives and the guy who sticks around gets burned, that's not a healthy structure. And that's the structure where we have a lot of these ETFs, and I just don't see the liquidity in those underlying markets being there, when everybody runs for the exit, and it's going to be enormously painful. People are going to complain, savings are going to be lost, and it's going to be the same level kind of populism, and I think it can really end, I think, fairly poorly, because there's no one on the other side to be a liquidity provider anymore. The Dodd-Frank, as much as Robert likes it, and there's obviously lots of good things about Dodd-Frank, but that liquidity provider historically pre-08 was the big banks. They're not liquidity providers anymore at all, and there is not going to be any natural liquidity.
Okay, so two very different versions of risk. Marc, have you got any that you'd like to nominate?
It's the tail. I can't tell you what the trigger is. I think there are always different triggers. I think the mark-to-market decline that we will see as a result of some of the factors that Jamie and I both hit on, I see as the number one thing that keeps me up at night. And it gets to what Ruth and Robert said. This is loss of confidence. You come back to assets equal liabilities plus equity. If you have a massive decline in assets that has nothing to do with the quality of the assets, but is a result of liquidity, companies are rendered insolvent, which is fine if there's long-term structures in place, but if there are not long-term structures in place and people start removing capital from places that have these kinds of mark-to-market, that's how you get a full-blown financial crisis.
Well,
last word.
What keeps me up at night is the chaos in this administration. I think it's literally you wake up to it, you go to sleep to it, and then you're sleeping with it. And long term, to me, it's our lack of fiscal discipline. I think that someone is going to have to pay the piper, and I think it's going to be the generations to come, but you cannot have trillions of dollars of deficit and think that no one's going to be paying for it. And so it goes back to what Jamie and Marc said. If we've already used all the tools to date and something really bad happens, what are those next tools? And I think we're going to have a real fiscal issue that is going to really hurt the system.
So I see lots of people leaving not because we've exceeded our time, which is no doubt product of the fact that I didn't do a very good job as moderator of this session. But let me end by trying to do it well, to thank everyone who's in the audience, but in particular to thank the people on the stage. Thanks a lot.
Happy to do it. Thank you.
Thank you. Thanks very much, everybody. Have a good evening. Good job.
Going out to dinner tonight?